The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's program brought to you by...
So she didn't inherit Grandpa's jawline, but there's no doubt she's family. It's your job to raise her, and it can be tough. Let's make it easier. With technology and automation, you can do more, like produce high-quality bales with way less effort. Built-in sensors can measure bale moisture and size, so you can monitor quality on the go and manage your fleet from your phone. Sit back and enjoy effortless operation. Discover an easier way to work.
Well, as we look at Thursday's trade action, another solid day to the upside in the grains and oil seeds. Soybeans the leader again. Quarter wheat, though, some moderate strength there. Pressure in the cattle complex with heavy losses in feeders on Thursday. Let's talk through the markets and get some perspective here on today's Market Talk, brought to you by John Deere Round Balers. Brian Doherty, Senior Market Advisor with Total Farm Marketing, joins us. And Brian, good to talk with you again this week, sir. I know I missed out last week being gone on the road, but happy to be back and talking with you as we enter the month of October. And here we are finding a little bit of green on the screen in the grain trade, Brian.
Yeah, it's interesting. Mr. Sarcastic me sometimes would say, well, of course the market's going to rally. It's October. It's price discovery for crop insurance, right? So, yeah, that aside, we've seen good export demand. Now, we're not going to be able to see it right away. And who knows how long, and we probably will not see crop ratings and some of the other things for a bit. I would like to think that what's happening, you look at the core market, about a 50% retracement. Now, what does that mean? That just means from the August low to the recent high. So basically, in December corn, 492, Jesse, up to just about 430. Let's call it 431. He took back about half that. Typical correction in a market, got a nice inverted head and shoulders formation formula. What's that? Well, that's another formation on a chart. So remember, charting is more of an art than a science. But these are things that if you're a buyer, you're looking at and go, I'd like to buy at a 50% retracement. I'd like to buy the inverted head and shoulders formation. And why would I buy? Well, I think what the backdrop to buying is just one time a year. We typically just don't see a lot of new fund buying pressure in the market after about this time window. It can happen, so we have to be careful. There's some years where it rallied into October, then dropped back and double bottomed in November and December. But I think the catalyst behind this continued recovery is just a healthy doubt, a healthy dose of doubt that the yield in corn and soybeans isn't going to live up to the current USDA projections. And so in theory, you might be tightening inventory up a little bit. Now, to keep rambling, I know there's a lot of naysayers that go, well, the USDA's way overestimated demand for the year ahead. And I might counter on that. We take a look at, people look at, a static, okay, what's the cattle herd? What's the dairy herd? What's hog? What's export, right? You look at all that and go, well, that's a 600 million bushel increase. When you're producing 16 billion bushels of corn, it is an increase. But if you expand each of those herd sectors, which cheap corn should do, it seems to me that is a doable objective. On top of that, when you look at what the USDA was trying to do this year, they kept continuing to move export demand up because it was underestimated last year. So the market is responding to cheap prices, and that's without a China buyer.
It's an interesting thing to think about as we look at those balance sheets, think about yield maybe coming down here as we go through harvest and that potential on the demand side here. And something else I've noticed as well, I think adds in here, Brian, in the grains, there's still a fair amount of carry in many of these markets right now, Brian.
Well, there is, and some of the bulls are betting that you're going to see that narrow in, that you'll see some inversion, and then once farmers put it in a bin, they're not going to take it out. And I used this term last year, and the year before, and the year before, but they don't take it out of the bin for the fun of it, right? They take it out of the bin when they can either make some money at it, or enough time has gone by, and then there's doubt creeping in whether they should continue to store it. Neither of those two factors, I think, come into play right now until the market rallies. The other thing is input prices are rallying, or rising, right? So, and inflation's rising. So if the market is going to maintain, or let's say maintain the number of corn acres this year, it's gotta do that through a pricing mechanism to encourage farmers to be corn producers. Right now, there's a lot of farmers looking at this going, huh, I wonder if I'm going to be farming next year. I got to have to bet,
Mhm.
So I just think the market has some work to do to create a solvent, let's say, marketplace where supplies are adequate but not overwhelming. And I know the argument, Jesse, is going to be, well, what are farmers going to do? I don't know. I don't have all the answers to that, but I know what farmers might not do is they might not plant or spend the inputs to plant the kind of crop that we had this past year.
And that's a broader conversation that I think is going to unfold over the next several months. Maybe we've had a little too much overproduction, and with the way things are in the economy, maybe some of those things we have to dial them back a little bit. And I know that in general, Brian, the risk management conversation is a tough one. We've touched on this for months now, and it's going to be different for everyone. And in some cases, it might be the case of you're selling grain to make sure you have the opportunity to farm in 26. I mean, I know that for a lot of folks, it's going to be a tough conversation as we go through the rest of this year and into early part of 2026.
It is a tough conversation, and it's a tough conversation for a farmer on all fronts. So he's got to talk to his lender. He's got to talk to, or she's got to talk to their spouse, their family, their partners, their father, their mother, their sons and daughters. Nothing is easy right now. Had an outstanding conversation with a very large farmer in Colorado this morning, a long-term customer, and we were just talking about doing things to mitigate losses. My mindset and his mindset is, look, I'm working hard to try and leverage everywhere I can and shop bases and do this and do that. But what he said, one thing I can't afford to do is I can't necessarily afford not to continue to do that. I have to work hard at this. Nothing's easy. And his mindset was, look, if I maybe get too aggressive selling this fall or selling into that carry, I am one phone call away. If you know how to do it, he said, I'm one phone call away, Brian, from owning whatever I want to own. So ownership's not necessarily a tough thing to do. You can do that through the futures market, very leveraged. It's do you want to take the leverage? First of all, that'd be one question. But the point of it is that now is not the time to just kind of give up on marketing. Look at the carry, to your point. Look at cost of storage. Look at basis. Look. Shop, shop, shop. There may not be any answers, or you might find, hey, there's a little gem in here. There's a diamond here. There's a diamond there. No easy answers. We're not likely to see corn market all of a sudden rally to 550. Not that it can't happen, but so let's go back. Let's just step back. What are drivers that could really push the market higher? Well, deal with China could certainly do that. At least change the momentum. The funds are still very short. They could buy a lot of they did last year, right? Um, Other things, and I think about this as I talk to farmers that are trying to get at corn. There's a lot of corn I think that's at risk because it has rust or some other issue where the stalk could get really brittle or weak. And looks like good weather now, so I think farmers are going to go at it as fast as they can. But if you've got a wet pattern, you really start to pick up the wind in that. This thing could look a lot different. You could be talking about losing a few 100 million bushels due to weather. So, and that's all what ifs right now. There's not. I'm not predicting any of that, but that's things that are on the radar that could happen yet in the weeks to come.
How about over in the livestock sector? Let's talk about that a little bit because I think just where our conversation's going today, a lot of risk management and big picture stuff here. Cattle, hogs, dairy complex, I know their own set of fundamentals and opportunity and volatility there. And curious if some of what's going on in the grain sector needs to be thought about on the protein side as well here, Brian.
Marketing never takes a day off, Jesse. That's my new phrase. I got a couple phrases this year. Marketing doesn't take a day off. The other one is stress risk, just the risk of the stress of all these low prices and not taking activity, which I'm no psychologist or what have you, but I do know that people say, look, when you're stressed and things, you got to keep busy, you got to keep looking, you got to keep working, you can't fret, think about it, you'll stress yourself out to death. So get at it. In these markets, let's look at the cattle. Looking to me like they've kind of made that push and recognized that demand can't sustain its higher levels. And so we've seen those cutout values drop fairly precipitously in the choice and select cut. So I focus in on that. That gives me, I think, a really good gauge of what's going on in the country. Feeders down today. The problem you have with the feeder market is, as of late, if you're buying feeders and you look out, you're looking at some losses and some pretty good losses already on the deferred live cattle. So you're betting on the come. That isn't anything new, but you're betting on the come at such a high level of price. So to reduce that stress risk, you've got to think strategically. Is it worth investing $5, let's say, on a cattle put as a safety valve? I think you have to. I think you have to look at that. You cannot afford the cattle market to have some kind of black swan event, or you didn't think they could go back down to 180 because at 200 we thought 180 was what we were protecting. So things can change, and I don't know if the consumer demand is able to hold up in that live cattle contract. There's a reason why the USDA is again indicating higher feed usage. I think they expect across the board expansion in all of the markets. Uh, why dairy herd's expanding? The beef herd we expect to grow. We don't know if it is for sure, but we expect hogs to grow. Who's not growing? So there's risk on the livestock side that has to be managed as well. So a little wordy, a little preachy, but don't drop the ball in marketing, whether you're in the cornfield harvesting or you're looking at cattle price shrugging shoulders. Well, I knew I shouldn't have done that marketing before, so I'll never do it again. You can't. That approach is a recipe for a train wreck.
The dairy complex as well, real quick. Just some notes there. Obviously, we know World Dairy Expo's happening right now in Madison, Wisconsin. Everyone in the industry is gathered there. A lot of conversations, but I know you and I have been talking about this. There's been plenty of volatility in the dairy markets recently. What do you see it as we enter October, Brian?
Well, there's been plenty of volatility, but the larger trend is still edging lower. And it's a direct reflection of increased production. There's no other way to go around that. I don't see any way to get around that. Here's the good news, though. Prices get down to level, and this isn't 1995, and it isn't 19 or 2005 or 2000. It's 2025. 16, $17 milk is an outstanding value to the world, to the U.S., to the consumer, to the processor. So it's challenging for me to be one of these naysayers that, oh, it's doom and gloom, doom and gloom. No, there's good demand. I think what the processors have done, though, collectively, whether they do it consciously or not, is they're a little bit in the driver's seat because of the production. So they don't have to jump as quickly as maybe they might in another time. But when some start to move, I think they all start to move. And so that creates this volatility where the market goes up and it goes down. So we've had some good recovery this week, very good recovery in a market that looked very ugly toward the end of last week. And so you've got different technical formations. You got one in the October. It's called a 1-2-3 bottom. That would point to higher. The November contract broke some resistance, and you've got a nice challenge and a nice recovery in that market. But I still got to come back to Jesse in the milk industry, dairy industry. The rallies are meant to be viewed as something to treat defensively somehow or another. I still worry that the bigger production numbers are coming. I'm not talking to anybody who said, "Oh, we're cutting back." I'm just not having those conversations. I don't have a great statistical sample survey. Someone would say, well, "You're talking to few people." That's true, but I get a pretty good sense of it, and I don't get a sense anybody's cutting back.
Brian, always enjoy the conversation. Anything final you'd share or reiterate with folks here today?
Well, I think I coined that phrase, marketing doesn't take a day off. So stay at it. I know everybody's busy. So one, stay safe because these warmer days, long days, working nearly around the clock, accidents happen. So don't, my brother once, when I was in high school, he gave a speech. He was older than me. And I always remember, he said, accidents don't happen. They are caused. Um, Inattentiveness, sleepiness, right? So, be smart is the bottom line. Things will get done. So that would be my first message. Second message is Yeah, keep your eye on the ball. Cattle are showing some signs that they've softened. Is it the break that's going to happen that we've been kind of worried about for a long time, or is it just a correction and an uptrend? We don't know yet. Demand has to cycle back in. And then lastly, Jesse, on the government shutdown, tariffs, all that kind of stuff, you can't control that. So you can only control what you can control as a farmer. So focus on that and focus on good risk management.
Good thoughts. If folks want to reach out and chat with you for a conversation, look at their marketing plan and more, there at Total Farm Marketing, how can they get in touch with you, Brian?
Well, we got great services. We got great products. They can get in touch with me through a phone call, 800-334-9779, and ask for Brian Doherty. There's two Brians here. Or email me, Brian with a Y at totalfarmmarketing.com, or take a look at our website and you can connect us through that. And that's totalfarmmarketing.com. But really love it when people ask questions. I can hear the question then, and then we can have a good, short, valuable conversation.
TotalFarmMarketing.com for all those details. Brian Doherty, always a pleasure, sir. Thanks for joining us. Have a great weekend. We'll talk to you next week.
Thank you, Jesse. Much appreciate it. Have a great one.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.